So good morning students, welcome you all on the second session and the last session on Ind AS 36 impairment of assets. So quickly we will recap what we have learned in the first day session. So we discussed what is the objective of impairment of assets. The counterpart standard is AS 28 in Indian GAAP and IAS 36 in IFRS. So the objective of the standard is to ensure that the asset side of the balance sheet, I mean to say the assets should not be carried at more than their recoverable amount. Okay. So recoverable amount is higher of fair value less cost to sell and value in use. Okay. So if the carrying value is higher than the recoverable value, then the differential will be treated as a impairment loss. So friends, we discussed this standard is applicable on all the assets except those assets which have been covered specifically in the particular standard. For example, inventory. So although inventory has to be recorded at cost or NRV, whichever is lower, but it is as per Ind AS 2. This decline is not as per Ind AS 36. So we have discussed so many standards, we have discussed so many items which have been covered as per the particular standard. For example, biological asset. So those biological assets have to be recorded at a fair value less cost to sell. So fair value could be higher, fair value could be lower. So if there is a decline in the value of biological asset, that decline has to be treated as per Ind AS 41, not as per Ind AS 36. So we have discussed some items which have been specifically covered under the particular standard. Okay. Then we discussed what is meant by recoverable value. Then we discussed what is meant by impairment loss. Impairment loss is equal to carrying value minus recoverable value. So quickly, I'll run through the PPT, and in the next 5 minutes, I'll recap the entire last session. I hope this PPT is visible. So this was the agenda. We have to discuss objective, scope, and meaning of impairment loss. We already discussed identification of an asset that may be impaired, measurement of recoverable amount, recognition and measurement of impairment loss, cash generating unit and goodwill, allocation and reversal of impairment loss, and disclosures. So we discussed this part of objective, we discussed the scope part. Then we discussed what is meant by impairment loss. Then we discussed this is higher of fair value less cost to sell and value in use. We have done a case study also. Then we discussed identification of an asset that may be impaired. So we discussed for every asset, we need to assess at the end of each reporting period that whether impairment indicators are existing. If impairment indicators are existing, then we have to go for the detailed impairment testing. Then we have to go for the estimation of recoverable amount, otherwise not. But we have discussed 3 exceptions to it. What are the 3 exceptions, Ambika? So we discussed 3 exceptions. One is intangible asset with an indefinite useful life, intangible asset not yet available for use, and goodwill acquired in business combination. So we discussed these are the 3 assets where you are not required to wait for the indicator of impairment. Rather, you have to perform an annual impairment exercise mandatorily. Sir, what happens if an intangible asset has been tested for impairment during the year? So it is okay if the intangible asset has been tested for impairment during the year, but it has to be tested for impairment in the next year at a consistent time. At a consistent time means frequency should be consistent. Okay. Sir, what happened if the intangible asset has been purchased during the year? In that case, the impairment testing has to be performed at least before end of the reporting period. Okay. Sir, what happens if on these kind of intangible asset during the year there are still indicators of impairment? For example, in case of a listed company, there are indicators of impairment on a quarterly basis. In that case, it has to be tested for impairment on a quarterly basis. So the mandatory timeline is at least once in a year. It could be more frequent. Okay. Then we discuss some internal indicator, external indicator. So evidence of obsolescence or physical damage, asset remaining idle, discontinuance, disposal or restructuring plans, declining asset performance. These are the example of internal indicator. External indicator, significant decline in the market value, changes in technological, market, economical or legal environment, changes in interest rate. So you remember, I have taken an example of present value calculation 10%, 15%. Okay. So when market interest rate will go up, your value will go down. Okay. So this is again an external indicator of impairment. Low market capitalization. Okay. Then we discuss recoverable amount, fair value less cost to sell, and value in use. We understood that since recoverable amount is higher of these two, so if an entity has calculated one amount, which is let's say fair value less cost to sell, and it is already higher than the carrying value, then there is no need to calculate value in use or vice versa. Then we discuss this illustration number 1 from Institute study material. Then we also discuss the meaning of fair value less cost of disposal. Fair value definition is as per Ind AS 113, and cost of disposal is a incremental cost directly attributable to the disposal of an asset or a cash generating unit, excluding finance cost and income tax expense. Example, legal cost, stamp duty, similar transaction taxes, cost of removing the asset, directly incremental cost to bring an asset into condition for its sale. We have also done a case study where valuation fee was not part of this cost, okay, and remaining other was the part of the cost of disposal. Then we discussed value in use. What is value in use? It is present value of the future cash flows expected to be derived from an asset or cash generating unit. So far we have not discussed cash generating unit. We will discuss in today's session. Okay. So what is value in use? So two things are important for value in use. First, estimation of future cash flows. Then applying the discount rate on those cash flows to arrive at a present value. Okay. Then we discussed that what needs to be reflected, your estimate of the future cash flow, which the entity expect from that particular asset, which is an underlying asset for impairment. And you need to take the cognizance of the future possible variations in the timing of the cash flow. Time value of money is appropriately reflected. Okay. And other factors, other situation, other market circumstances needs to be taken into consideration. Okay, then what is the basis for estimate? The basis of estimate means, so greater weight should be given to external evidence. Most recent financial budget needs to be considered. Projection should not be for more than 5 years. And the asset, so whatever the current condition of the asset is, so the projection should be made on the basis of the current condition of the asset over the remaining useful life. What cash flow includes? Cash flow includes the cash flow which has to become the cash flow, the cash inflow from that particular asset according to current condition, and the cash outflow directly attributable to generating the cash inflow. Okay. So terminal cash flow is also part of your cash inflow. Okay. And this cash flow should be from the continuing use of the asset. So these 4 items were the inclusion. What is exclusion? Future restructuring or reorganization cost is not to be included. If the company is planning to improve the asset performance by incurring a huge expenditure in future, it is not included in the cash flow. Financing activities and income tax receipt or payment should not be included in the cash flow for calculating value in use. What is the discount rate? So discount rate is a pre-tax market rate. Discount rate is a pre-tax interest rate which is related to a particular asset. Time value of money and risk is specific to the asset. For example, you want to do an impairment testing of a particular asset for a period of 5 years. You need to take a discount rate of 5 years. You need to take an interest rate of 5 years. Okay. But if the risk is specific rate for the particular asset is not available, then you can go for entity weighted average cost of capital or incremental rate of borrowing, incremental borrowing rate. Okay. Then we discuss what happens if the company has some foreign currency assets and the company is generating a cash flow from the foreign currency assets. Then we discussed 3 steps. We discussed you need to estimate the future cash flows in the foreign currency. Then you need to apply the discount rate applicable to the foreign currency. Then you need to translate the value in use which is there in the foreign currency using the spot rate into the Indian currency. Okay. So 3 steps we have discussed. Is it right, Costa? Chavi, Costa, Niharika, Rohan, Shreyans, Dinesh? Is it okay? Srishti, is it okay? Great. Then we discuss this case study from Institute study material, which is from Test Your Knowledge, question number 7. So we discuss this case study also. Then we discuss a detailed case study on calculation of value in use, on calculation of recoverable amount, on calculation of revised carrying amount, and calculation of revised depreciation. So we have discussed this particular case study also. Okay, so we discussed this impairment loss is equal to carrying value minus recoverable value. Now we'll discuss some key points. What are those key points? Guys, I hope my audio and video is audible and visible to everyone. There is no any problem so far. Okay, great. So friends, now we'll discuss some key points. First of all, impairment loss should be recognized immediately in profit or loss unless the asset is carried at revalued amount. Unless the asset is carried at revalued amount. So what does it mean? It means so friends, now I'm moving on to the today's session. So I have recapped the earlier session. Let me know if you have any query regarding the last day session. Okay, first of all, what are the key points? So this impairment loss should be charged to P&L. Impairment loss should be charged to P&L. But there is one exception. If the entity is using a revaluation model. So remember the revaluation model which we have discussed in Ind AS 16 and Ind AS 38. For example, the entity has used a revaluation model. So the cost of the asset or carrying value of the asset was 100 and the revalued amount was 120. So the company has credited 20 rupees into the OCI, other comprehensive income, as a revaluation surplus. Now there is an impairment, there is an indicator of impairment, and the company has done the impairment exercise, and now this 120 become 105. Then what will happen with 15 rupees? So this 15 rupee will not charge to P&L. This 15 rupees will be debited to OCI, other comprehensive income. So what is the mool mantra? The mool mantra is whatever is available into OCI. If there is any loss, you need to adjust your OCI first. And if there is a over and above loss, which is more than the OCI, then you need to charge it to the profit and loss account. Okay. So for a revalued asset, and if the company is taking it at a cost model, then of course impairment loss will go to P&L. But if the company is taking it a revaluation model, then this impairment loss will be treated as a decrease in revaluation. It will be treated as a decrease in revaluation. Okay. So you need to see if it is a cost model, then of course every time it will go to P&L. And if it is a revaluation model, then it will be treated as a revaluation increase or decrease. Okay. Then all those Ind AS 16 and 38 principle will apply. Understood? So then your future depreciation or future amortization will be of course at revised carrying value. For example, so this 120 become 105 and the remaining life is, let's say, 8 years. So this 105 has to be depreciated over a period of 8 years. Okay. So this is the, again, one of the key points which we already understood and which we are already aware of. Okay. Now the next point is deferred tax asset or deferred tax liability. Very important point. So deferred tax asset or deferred tax liability will also be impacted. I hope you all have learned or you all have understood Ind AS 12 so far. Have you had the session on Ind AS 12 income taxes? Have you had the session? So standard says that your deferred tax asset and deferred tax liability is required to be created or is required to be compared with the revised carrying value of the asset. It has to be compared with the revised carrying value of the asset. So let me take you through a case study on this deferred tax asset. So this is from Institute study material. Mercury Limited has an identifiable asset with a carrying amount of rupees 1000. This is illustration number 5. Illustration number 5, page number 7.227 of the Institute study material. Mercury Limited has an identifiable asset with a carrying amount of rupees 1000. Its recoverable amount is rupees 650. The tax rate is 30% and the tax base of the asset is 800. Impairment losses are not deductible for tax purposes. The effect of the impairment loss is as follows. The effect of the impairment loss is as follows. Okay. Now, how to calculate deferred tax assets and liability in this case? In this case, first of all, how to calculate the deferred tax asset and liability? As per Ind AS 12, deferred tax assets and liability has to be calculated by comparing the tax base with the book base, by comparing the tax base with the carrying value. So first of all, in this question, this Mercury Limited has an asset with a carrying amount of rupees 1000. So first of all, what is the carrying value? Illustration number 5, page number 7.227 of ICAI study material. So the carrying value is 1000. And what is your tax base? What is meant by tax base? Tax base means if you will prepare the balance sheet as per income tax provision, then what is the carrying value? What is the asset and liability in that tax balance sheet? Okay. So the carrying value is 1000, recoverable amount is 650, and the tax rate is 30%, and tax base of the asset is 800. So tax base is 800. Okay. So see, the carrying value is higher. The carrying value of the asset is higher than the tax base of the asset. So in this case, what will happen? What will happen? So I'll give you a quick trick on this. I will give you a quick trick on this deferred tax asset. In the deferred tax asset, just raise your two hands. I hope you all are aware about this magic trick. Are you aware about this magic trick? Guys, are you aware about this magic trick of deferred tax asset and deferred tax liability? Are you aware about this? Let me know quickly. There are a lot of confusion whether it will be deferred tax asset or deferred tax liability. So there is a quick trick how to calculate the deferred tax asset or deferred tax liability. Please confirm. Okay. So let me tell you the trick. In the left hand, or in, let's say, in any hand, if this is your company's books, this is your carrying value, and this is your tax base. Okay. On one hand carrying value, on one hand tax base is there. Okay. So whatever you will do, whatever accounting you will do in your company's books. You will do in your company's books. You will not allowed to do any accounting in the tax books, because tax books pertains to tax department. Okay. So first of all, let's say the value of the asset in the carrying value, the value of the asset in the company's books is higher. In this case, it is 1000, and the tax base is lower. The asset tax base is lower, 800. So now what is the objective of deferred tax? It is a matching concept. It is to align the company's books with the tax books. Okay. So in the one hand, we have taken company's books. We have taken a carrying value of the asset, book base of the asset. In the second hand, we have taken the tax base of the asset. So what is the book base? Book base is 1000. What is tax base? Tax base is 800. So tax base is lower than the book base. So to align both the number, what I need to require? I have to reduce the value of the asset in my books. I have to reduce the value of the asset in my books. It means I have to reverse the asset. If I need to reverse the asset, what does it mean? It means I have to create a liability. So in this case, what will happen? In this case, deferred tax liability will be created. Because my asset is higher in the books. So I need to reverse my asset. So, but if I need to reverse my asset, whether I need to reverse this asset, answer is no. I need to reverse tax asset. It means I need to create a deferred tax liability. And deferred tax liability is between these two amounts. What is the difference? What is the temporary difference? The temporary difference is 200, and deferred tax liability will be created at the rate of 30%. DTL at the rate of 30%. So 60 rupees liability will be created. So Pujita, Ambika, are you all okay? Will you remember this magic trick? So this trick will help you quickly, whether it will be DTA or it will be DTL. Okay, friends. So now in the question it is written that the impairment loss is not a tax deductible loss. Okay. and the recoverable amount is 650. So this carrying value of 1000 becomes 650. Okay, but tax base remains same, 800. Now what will happen? Now what will happen? In this case, my carrying value, my value in the company's books is 650, but my value in the textbooks is 800. Okay, so it is higher. In this case, I have to increase my asset size. I have to increase my asset. It means it will be deferred tax asset. So 650 minus 800, 150. And what is the deferred tax at the rate of 30%? 45. So I need to create a deferred tax asset. So what is the difference between these two? Earlier it was liability, now it is an asset. So it means I need to create a deferred tax asset of 105. Okay, I need to create a deferred tax asset of 105. Technically, which is the difference between the impairment loss, 1000 minus 350. Understood? So this is a balance sheet number, this 45. Guys, have you understood this concept? Have you understood this example? Yes, Ambika, you're right. Kaustubh, Chavi, Pujita, Shreyans, Dinesh, Mukul. Is it okay? Great, great friends. So we understood the concept of DTA, DTL and also. Now let's move on to the next concept, very, very critical and very important concept, which is cash generating unit, which is CGU, cash generating unit. Okay. So friends, what is meant by cash generating unit? If you will read this Ind AS 36 impairment of assets, so wherever right from the objective part, wherever the word asset is given, wherever the word asset is written, the word cash generating unit is also written. Okay. So first of all, this standard is applicable on asset, and this standard is also applicable on group of assets. This standard is also applicable on group of asset, asset and group of asset, asset and group of asset. Okay, asset and group of asset. So the concept of asset we have discussed, the concept of asset we have discussed, but the concept of group of assets we are discussing. So what is this group of asset? This group of asset is known as a CGU, cash generating unit. The group of the asset is known as a CGU, cash generating unit. Okay. Now, can anyone help me in understanding what is meant by cash generating unit? What is meant by cash generating unit? Which group of asset will known as a cash generating unit? Can I say there are three assets? There are three assets. Asset A, B, and C. There are three assets. Asset A, B, and C. Neither of these assets are cash generating assets. I mean to say, neither of these assets are generating cash flow. Neither of these assets are independently capable of generating cash flow, nor these assets together will be able to generate a cash flow. So अगर ये तीन assets मिल जाएं, तो भी ये cash flow generate नहीं कर सकते. So these three assets will not be able to generate cash flow either independently or to be clubbed as a group. So can I say these three assets, these three group of assets will be a cash generating unit? Can I say that? Pujita, what is meant by cash generating unit? What is meant by cash generating unit? What is meant by cash generating unit? So Pujita is saying a unit which can independently earn revenue to an entity is a cash generating unit. It can have many assets. Yes, you're right. You're absolutely right. What is cash generating unit? Now the definition is The definition is a smallest group of assets, smallest group of assets which can generate a smallest group of assets which can generate cash flow independently from other assets, or group of assets, other assets or other group of assets. So what is it? A smallest identifiable group of assets, a smallest group of assets. So in the organization, what is the smallest group of assets? Which can generate cash flow independently from the other assets or other group of assets. Okay. For example, there are three machines: machine A, machine B, and machine C. Okay. So machine A, so this is a machine A. This machine A used to process the raw material. So this machine A used to process the raw material. Okay. And when this machine A process the raw material, it goes to machine B. Okay. So after processing of raw material from machine B, it goes to machine C. Okay. And when it comes to machine C produces the final output. Okay. Which is sellable into the market. So machine C produces the final output which is sellable in the market. Okay, so this is sellable in the market. Now the thing is, can I say this machine A, which is only processing the raw material, can I say this machine A can generate the cash flow independently? Can I say, Kaustav? Can I say this machine A can generate the cash flow independently? Answer is no. Can I say this machine B can generate the cash flow independently? Answer is no. But this machine C can generate the cash flow because the final output comes to machine C. But without support of machine A and machine B, machine C cannot generate the cash flow independently. So in this case, what is the smallest group of assets which can generate cash flow independently? What is the smallest group of assets? The smallest group of assets is machine A, B, and C. So this is known as the smallest group of assets which can generate cash flow independently, which can generate value in use, okay, independently, and hence this A, B, and C is considered as a CGU, as a cash generating unit. So what is the concept? The concept is, first of all, you have to check the impairment testing. You have to check the impairment loss at an asset level. Okay. First of all, you need to check the impairment loss at an asset level. If the computation of impairment loss at the asset level is not measurable, in that case, you need to go for a group of asset. You need to go for a group of asset to which that particular asset belongs. Okay. And that group of asset will be a smallest group of asset which can generate cash flow, and on which the value in use can be computed. Okay. So yes, in this case, this is a cash generating unit. So could be the example of cash generating unit could be, for example, when you go to a Jindal Steel and Power Limited. So there are a lot of plants, sinter plant, then your plate mill. Okay. So in the factories, you need to see if there are 3 different plants, if there are 3 different assembly line, then that assembly line will be treated as a cash generating unit. Or even in the companies where there are different factories, so they treat one factory as a cash generating unit because that factory itself is capable of generating a cash. Okay, capable of generating a cash. Now I'll take another example. There is a company, there is a transport company. and the transport company has got a license from the government, a permit from the government to run some buses on a particular route. Okay, so let me clarify this example here. So there is a transport company, ABC Transport Company. Okay, there is a transport company, ABC Transport Limited. ABC Transport Limited. This ABC Transport Limited got a permit, got a license to run buses in Delhi. Okay, and the government has given a license to run five buses at 5 different routes. Okay, so it got a license to run buses in Delhi. So there are 5 buses in the company. There are 5 buses. Okay, and the government has given license to run these 5 buses at 5 different routes. So this is route number, this one bus, bus number 1, bus number 2, bus number 3, bus number 4, bus number 5. Okay, so this is route 1, this is R1, route 1, R2, route 2, route 3, route 4 and route 5. Okay, so this R1 is into profit, this R1 is into profit, this route is into profit, this R2 is again in profit, this R2 is again in profit, this R3 is in profit, this R4 is into losses, and this R5 is also into losses. Okay, now my question is, so in every route the buses are separate, in every route the buses are separate, am I right? So one bus will run in one route at a time. So for every route there is a dedicated bus, there is a dedicated driver, there is a dedicated conductor. Okay, there is a separate cash flow. So there is a separate revenue by selling of tickets. There is a separate cost like diesel cost, like fuel cost, okay, maintenance cost, repair cost. So everything is separate. So the company can analyze cash flow. The company can analyze cash flow for every route separately. Am I right? Am I right? So the cost of the bus, the cost of the conductor, driver, cost of diesel, cost of fuel, cost of maintenance, revenue by selling of tickets. Okay, so at every route it can be taken separately, but the condition is the government has given a condition that I'll give you license if you will run the bus in all these 5 routes. If you will run the bus on all these 5 routes, if you will discontinue any particular route, I'll cancel the entire license. I'll cancel the entire license. Okay, have you understood my question? So this is a transport company. This has 5 buses. These 5 buses are operating into 5 different routes. Okay, the government has given a license to run these 5 buses on these 5 routes, and the government has told that you need to run your bus in this entire 5 routes together. In this entire 5 routes together. Okay, if you will cancel any route, I'll cancel your entire license. Okay, so now you are the auditor of the company. You are auditor of ABC Transport Limited, and ABC Transport Limited is saying, see, my 3 routes are into profit, so there is no indicator of impairment. My 4th and 5th route is into losses, so I need to check, I need to do the impairment assessment, I need to check the impairment loss only for this route number 4 and route number 5, whether contention of ABC Limited is right. What is your view, guys? What is your view? What is your view? This is a very important question which is also there in the institute study material to understand the CGU concept. Whether the entire 5 routes together, whether the entire 5 buses together, 5 routes together is a cash generating unit, or every single route is a cash generating unit. Tell me. Kaustav, Nanda, Ambika, Pujita, what is your view? What is your view on this? Ambika is saying, sir, it is all 5 are CGU because license is common. So impairment loss is required to be checked for group. How many of you second Ambika? How many of you are with Ambika? Okay. So one of the participant Rohan is also saying, sir, since the company cannot operate on a single route and the company has to operate for entire 5 routes together, if the company will cancel one route, the government will cancel the license for entire 5 routes, and hence this 5 routes is considered as a smallest group, smallest identifiable group of asset which can generate cash flow, and hence it is a cash generating unit. This 5 routes put together is a cash generating unit. You are right, Rohan, you are right. Okay, so guys, have you understood the concept of cash generating unit? Kaustav is saying, no sir, ABC Limited will have to check impairment for the entire 5 routes together. Yes, Kaustav, you're right, and this entire 5 route is a cash generating unit. So this bus company as a whole, these 5 routes as a whole, these 5 buses as a whole will be the cash generating unit. Perfect, guys. So friends, let me share my screen once again. Let me share my PowerPoint presentation. So what is a cash generating unit? You need to determine recoverable amount for the individual asset. If it is not possible to estimate the recoverable amount of the individual asset, then an entity should determine the recoverable amount of the cash generating unit to which the asset belongs. Okay. So I have already explained this part. What is cash generating unit? It is the smallest identifiable group of assets which generate cash inflows that are largely independent of the cash inflows from the other asset or other group of assets. Okay, for example, 2 different assembly lines. Okay, so these are considered as a cash generating unit. For example, a building. The company has 5 buildings, and every building has given on a rent basis. Every building has been given on a rent. Okay, in this case, the every separate building will be considered as a cash generating unit, because a single building can generate a cash flow in terms of rental income. So the maintenance cost is separate for a particular building. The cost of the building is separate. The terminal value of the building is separate. So value in use can be calculated. Fair value less cost to sell can be calculated. Recoverable amount can be calculated for that particular building. Okay. But if there is some legal restriction, there is some clause, there is some contract that the company has 2 buildings put together. Okay. So in that case, the company has to provide these 2 buildings together on rental basis to a single party. Okay. If these are some kind of restrictions which cannot allow the company to generate cash flow from a particular building individually, in that case, these 2 buildings put together will be considered as a cash generating unit. So you need to see what is the smallest group by which the company can earn revenues, by which the company can generate cash flow. You need to see. Okay, is it okay? Any doubt so far? Any problem? Are you comfortable so far? So welcome again, students. I hope the issue have been fixed. So we discussed the identification of CGU, and I am sharing my screen. So we discussed the ability to generate independent cash flow from other assets. So if an active market exists for the output produced by a group of assets, that group of assets should be identified as a cash generating unit, even if some or all of the output is used internally. We discussed this part here. Then how management makes a decision about continuing or disposing of assets or operation. So how management monitor the operations such as by product line, businesses, individual location, district, regional area, geographies. So again, it is very important for determination of CGU. Then CGU should be identified consistently from a period to period for the same asset or type of asset unless a change is justified. For example, the company has changed its location. The company has changed the product line. Okay. So if there is a change which is justified, then a CGU could be changed. But otherwise, cash generating unit once identified should be consistently from one period to another. Okay. Let's do a case study, illustration number 17 from Institute study material. Please confirm, I hope my audio and video both is audible and visible to you guys. You all are comfortable so far? Okay, so mining entity owns a private railway to support its mining activities. The private railway could only be sold for scrap value and it does not generate cash inflow, which are largely independent of the cash inflow from the other assets of the mine. So there is a mining company, there is a mine company. That mine company has its railway, its own railway for loading and unloading the material. Okay, so that private railway cannot generate independent cash flow. Of course, it could be sold as a scrap value, but it cannot generate a cash flow independently from the other mining asset. Should the entity determine the recoverable amount for the private railway or the mining business as a whole? So the ask of the question is whether this private railway is a cash generating unit or the mining business as a whole, including this private railway, will be considered as a cash generating unit. So the answer is the entire mining business, including private railway, will be considered as a cash generating unit. Why? Because it is not possible to estimate the recoverable amount of the private railway because its value in use cannot be determined and is probably different from the scrap value. Okay. Of course, this private railway is providing a productivity. This private railway is providing a future economic benefit, but since it is not generating the cash flow independently, so recoverable value cannot be calculated. Okay. So therefore, the entity estimate the recoverable amount as a cash generating unit to which the private railway belongs. That is the mine as a whole. Okay. So have you understood this particular case study? So Ambika has confirmed, yes, sir. Now the audio and video is comfortable. It is okay. What about others? So we discussed the cash generating unit. We discussed this particular case study. Now let's move on to the next part. Goodwill. So allocation to CGU. Very important part. Very important part. So Pujita has also confirmed. Great, guys. So what is meant by goodwill? What is goodwill? So far we have understood in Ind AS 38, if you remember. So we discussed the concept of intangible asset from business combination. When there is a business combination, some intangible asset have arisen because of business combination, because the company is paying a premium. The acquirer is paying a premium to the acquiree for acquisition of its business. Okay. So friends, what is goodwill? Goodwill is something which you are paying extra. For example, the value of the net assets is 100 rupees and acquirer is paying 120 rupees. So why acquirer is paying 20 rupees extra? The acquirer is paying 20 rupees extra because the acquirer is looking for some synergy benefits by acquisition of that particular business. Okay. So the acquirer is estimating when I will acquire that particular business. Okay. So that particular business, when it will combine with me, it will provide me synergy. It will provide synergy to my existing assets also. It will provide a future economic benefit to my existing asset also. That is why that acquirer is acquiring a business of the acquiree. So in this case, now the question arises, if there is a goodwill, so how this goodwill has to be allocated? So standard says that the goodwill acquired in a business combination. Now, before explaining this, let me ask one question more. If there is an internally generated goodwill, so Ambika is asking one question, sir, if private railway is of immaterial amount as compared to entire organization. So it doesn't matter, Ambika, still. So I'm not saying this private railway is a cash generating unit. So I am saying, the question is saying this private railway does not generate cash flow independently. And hence this private railway has to be clubbed with the entire mining business for considering cash generating unit, for considering the impairment assessment. Okay. So this private railway is a part of the entire mining business, and entire mining business will be considered as a cash generating unit. Okay. So friends, now we were discussing, sir, if there is a business acquisition, business combination, and in business combination, if there is a goodwill, okay, then whether goodwill is allocated to cash generating unit for doing an impairment assessment. Answer is yes. Why? Because that goodwill denotes, if you are paying something extra, it denotes that that goodwill is providing a synergy, will provide a future economic benefit to the existing cash generating units, Now my question was, sir, whether we need to consider internally generated goodwill also? Do we need to consider internally generated goodwill also? Guys, whether internally generated goodwill can be recognized as per Ind AS 38? Answer is no. So if something which is not recognized, there is no question arise for impairment assessment, because there is no asset. Okay. But we have understood, we have learned in Ind AS 38 that goodwill can be arised by way of business combination. It is a purchased goodwill. Okay. So in the next session, you will read Ind AS 103 also, which is business combination. So we'll discuss these concepts in detail for goodwill. Okay. So standard says that goodwill acquired in business combination should be allocated from the acquisition date to each of the acquirer's cash generating unit, that is expected to benefit from the synergy of the combination. I know that when I am acquiring a license of when I am acquiring a pharmaceutical business, so of course I am getting the benefit of my 3 cash generating unit. I am getting a benefit in my 3 cash generating unit by using that particular formula of the pharmaceutical company which I am acquiring. Okay. So in that case, whatever premium I am paying extra, for example, I am paying 20 lakh rupees extra. So this 20 lakh rupees has to be allocated into 3 CGU, which are expected to get the benefit from the acquisition. Okay. So this goodwill has to be allocated into the cash generating unit. Okay. So even if the assets and liabilities of the acquiree are assigned to those units or group of units to which the goodwill is so allocated, such allocated units should represent the lowest level within the entity at which the goodwill is monitored for internal management purposes. What does it mean? It means whenever you have to allocate the goodwill to cash generating unit, you need to allocate the goodwill to the lowest level of the entity, to the lowest level of the smallest level of the group of assets. Okay. So if there are 5 assets which can generate independent cash flow, that goodwill has to be allocated into those 5 assets. Okay. So it has to be allocated to the lowest level of the assets in which the entity is monitoring the cash flow, But there is one exception. It says that at that lowest level should not be larger than an operating segment as per Ind AS 108. Have you read Ind AS 108 operating segment? Have you read Ind AS 108 operating segments? If you remember, for identifying a reporting segment, there is a threshold of 10% of revenue, 10% of profit or loss, 10% of assets. Okay. So it says that first of all, goodwill has to be allocated to those cash generating unit which are expecting to get the benefit of the acquisition. First thing. Second thing, goodwill has to be allocated at the lowest level at which the entity is monitoring the cash flow. Third point, it should not be that particular CGU on which the goodwill is allocated. It should not be larger than the operating segment, reporting segment as per Ind AS 108. 8. Okay. Now, a very important concept. So there is a cash generating unit. There is a CGU, cash generating unit. CGU. And that CGU is having, there is a CGU, cash generating unit. And this CGU is having intangible asset with indefinite life and goodwill. This CGU is having intangible asset with indefinite life and goodwill. Okay. Okay. So there are two conditions. One is no indication of impairment. No indication of impairment. So there is no indication of impairment. Friends, whether the impairment testing is required. This is a cash generating unit, and this cash generating unit is having two assets. This cash generating unit is having two assets. Apart from other assets, this cash generating unit is having intangible asset with indefinite life and goodwill. So my question is, if there is no indicator of impairment, still whether impairment testing is required? What is your view? Costa, what is your view? In this case, whether impairment testing is required? Yes. So it is required on an annual basis. It is required annually. It is required annually. So annual impairment testing is required. Annual impairment testing is required. So test for impairment at least annually. Okay. But here indicator of impairment is there. Indicator is there. Then what will happen? So in this case, since this is having an indefinite life and goodwill, so this group of asset includes indefinite life and goodwill. So in this case, at least annually impairment testing is required, even though there is no indicator of impairment. But if yes, it is an indicator of impairment, then you go for impairment testing on a more frequent basis. Whenever there is a impairment indicator, impairment testing, you have to go for impairment testing on a more frequent basis. Okay. Is it okay? Yes, Kostav, you are right. Now I am flipping this particular question. In this CGU, there is no CGU, no exception assets, no exceptional asset. Then what will happen? In the cash generating unit, there is no exceptional asset, no goodwill, no intangible asset with indefinite life, no intangible asset not yet available for use. Then what will happen? There is no indication of impairment. If there is no indication of impairment, impairment testing is not required. Impairment testing not required. If there is indication of impairment, impairment testing is required. Test for impairment. Any doubt? Any doubt? Is it clear? Guys, is it clear? Okay. So let me share my screen once again. So friends, I am explaining the concept on the whiteboard, then I am explaining, then I am showing it on the PowerPoint presentation also, so that you will have a revision simultaneously. So this is cash generating unit with goodwill, intangible asset with indefinite life or not yet available for use. We are talking about impairment testing, frequency and timing. If indication of impairment is there, you are required to test for impairment more frequently. If there is no indication of impairment, you are required to test for impairment on annual basis. Asset or CGU other than goodwill, intangible asset with indefinite life or not yet available for use. If indication of impairment is there, you are required to test for impairment. If indication of impairment is not there, then you are not required to test for impairment. Okay, so we discussed this part. Then what are the other key points? So annual impairment test for a CGU to which goodwill has been allocated may be performed at any time during an annual period. Okay, but it should be consistent. The frequency should be consistent. Different CGU may be tested for impairment at different time. Again, for those particular CGU, frequency should be consistent. If the impairment testing has been done for a CGU A in June 2019, so it should be somewhere in June 2020 in the next year. Okay, so the different CGU can be tested for impairment at different time, but the frequency should be consistent. Okay, so recent calculation made in a preceding period can be used if the following criteria are met. I have told you the impairment testing, calculation of recoverable amount, it is a cost and time consuming exercise. For example, in the last year you have done a calculation of value in use for a particular CGU, and when you have arrived at a value in use or fair value less cost to sell, the amount was significantly higher than the carrying value, significantly higher than the carrying value. It means a lot of headroom was available. Okay, for example, the carrying value was 100 crores and that recoverable amount was 150 crores at that point of time. And if we are comparing the current economic condition or current situation with the last year situation, the economic condition or the business situation has not been significantly changed. So in this case, standard says that instead of going for a revised calculation, the management can use an earlier calculation if earlier calculation was significantly higher than the carrying value in the last period, provided no economic condition has been significantly changed. Okay. So Ambika is asking, sir, if goodwill acquired in business combination, it is allocated to lowest level within the entity, means CGU lowest cash flow, is it? Yes, Ambika. So it has to be allocated to the lowest CGUs, so lowest group of identifiable assets which can generate cash flow. Now, second important concept, corporate asset. What is meant by corporate asset? Before showing this screen, I want to understand from your mouth what is corporate asset. Guys, what is corporate asset? So we have discussed the concept of goodwill. Now we are discussing the concept of corporate asset. Costa, what is meant by corporate asset? What is meant by corporate assets? Anyone who can tell me what is meant by corporate asset? Technically, we are talking about assets which can generate cash flow, or a group of assets which can generate cash flow. So have you heard about the cost center? When you go for audit, so sales and marketing department, so they are known as a profit center. Why? Because they help in generating revenue of the company. If I talk about finance department is considered as a cost center. Why? Because the finance department is a back-end department, sales and marketing department is a front-end department. They are directly dealing with the customers. Okay. So likewise, if I talk about factory building, factory building is something which helps in the production. Okay. But if I talk about office building, so whether office building helps in the production, answer is no. Whether it helps in the production of goods and services, answer is no. So what is a corporate asset? So corporate asset are something which is not directly related to the generation of cash flow, which is not directly related to generating cash flow, but it is something which helps, which support the respective function or department, the respective cash generating unit to generate the cash flow. For example, research and development center. In pharmaceutical companies, the big chunk of the asset is into research and development center also. This R&D center supports the marketing team, supports the product team to analyze which product is suitable as of now. For example, in pharmaceutical industries, so a lot of scientists are working on this COVID vaccine. So whether this research and development center is not critical, this is very, very, very critical. But this is not engaged in directly earning revenue or earning cash flow. So this is something, this office building, head office building, okay, your safety equipment, your research and development center, these are something which supports, which helps in generation of cash flows to the other departments. Okay. Now standard says that, so how to treat the assessment of impairment assessment of these corporate assets. So standard says that these corporate assets has to be allocated to the cash generating unit on a reasonable basis. Okay. For example, in a company there are 5 cash generating unit. Okay. So the value of the 5 cash generating unit is, let's say, 500,000, 500,000, 500,000, 500,000, 500,000. Okay. So every cash generating unit has a carrying value of 5 lakh. Now there is a corporate asset, let's say office building. The value of the office building is 10 lakh. So standard says that it has to be allocated on a reasonable basis. So reasonable basis means in the pro rata, in the proportion of their carrying values. So in this case, this 10 lakh or 20 lakh has to be allocated 1:1:1:1 equally into these 5 cash generating unit for the purpose of calculation of impairment loss. For the purpose of calculation of impairment loss. Okay. So friends, what is a corporate asset? So corporate asset is something which is not directly engaged into generation of cash flow, but it supports generation of cash flow. So let me tell you, corporate assets are assets. I hope my screen is visible to you guys. Corporate assets are assets other than goodwill that contribute to the future cash flow of both the CGU under review and other CGU. Okay. Distinctive characteristics of corporate assets are that they do not generate cash flow independently of the other assets. Hence, the recoverable amount of an individual corporate asset cannot be determined. So you cannot determine the recoverable amount of an individual corporate asset. You cannot calculate the value in use. Office building. Office building is engaged in running the operation of the business. Okay. So they are not into the production of goods and services. So it is difficult to calculate value in use. Therefore, recoverable amount is determined for the CGU to which the corporate asset belongs and is compared with the carrying amount of this particular CGU. Okay. So first of all, you need to allocate the value of the corporate asset to the cash generating unit on a reasonable basis. Then you need to compare the revised carrying value of the cash generating unit, including corporate asset, with the recoverable amount of the CGU. And after that, if there is any impairment loss, you need to charge the impairment loss to the corporate asset and the other assets of the CGU pro rata. Okay. Sir, how does it work? So let me take you through with an example. So first of all, I'll take you with an example of this corporate asset, illustration number 10. So let me share my screen of this ICAI study material, illustration number, not 10, illustration number 11. Is it visible? Whether this illustration number 11 is visible? So this is illustration number 11, page number 7.234. With the help of this illustration, we will discuss how this corporate asset will be allocated and how the impairment loss on the corporate asset will be allocated. Okay. So allocation of corporate asset into CGU and the assessment of impairment loss on a corporate asset. Okay. Earth Infra Limited has 2 cash generating unit X and Y. There is no goodwill within the units carrying values. The carrying value of the CGU are CGU A for 20 million, CGU B for 30 million. In this question, instead of X and Y, it should be A or B. It should be A and B. Okay. So don't confuse that the first line is X and Y, then after that the information pertaining to A and B has been given. So this X and Y should be replaced with A and B. Earth Infra has two CGU, A and B. There is no goodwill within the unit's carrying values. There is no goodwill. Okay. The carrying value of the CGU are CGU A for 20 million and CGU B for 30 million. The carrying value of the CGU are given. The company has an office building which it is using as an office headquarters and has not been included in the above values and can be allocated to the units on the basis of their carrying value. So there is a corporate asset. Okay. So this corporate asset has not been allocated so far, but yes, it has to be allocated on the basis of the carrying values. It means the carrying value is 20 million and 30 million, 2:3. And the value of the carrying value of the corporate asset, which is an office building, is 10 million. The recoverable amount are based on value in use of 18 million for CGU A and 38 million for CGU B. Okay. So recoverable value is also given here. You are required to determine whether the carrying value of CGU A and B are impaired. You are also required to determine the revised carrying value of corporate asset. Okay. Whether question is clear to everyone? Whether question is clear to everyone? Whether question is clear to everyone? Okay. So let's move on to the whiteboard to explain this particular question or concept. First of all, the carrying value. This is A, this is B, and this is total. Now, carrying value of CGU. What is the carrying value of CGU which is given in the question? Carrying value of CGU is 20 million and 30 million. Okay. The total is 50 million. Okay. Then the value of corporate asset. What is the value of corporate asset? The value of corporate asset is 10 million. This 10 million has to be allocated in the proportion of carrying values, which is 2:3. 2:3. Then what is the value of corporate asset which needs to be allocated? So corporate asset allocated should be 10 into 2/5 and 10 into 3/5, which is 4 and 6 million. The total is 10 million. Okay. So what is the total here? 24 million, 36 million, and total 60 million. Now, so this is a carrying value after allocation of corporate asset. Now, friends, what is the recoverable amount given in the question? What is the recoverable amount given in the question for CGU? The recoverable amount of CGU A is 18 million and the recoverable amount for CGU B is 38 million. Okay. So in this case, if you will compare the carrying value with the recoverable value, here the recoverable value is lower than the carrying value and there is an impairment loss of 6 million. But if you will compare in CGU B, the carrying value is already lower than the recoverable value and hence there is no any impairment loss. And hence there is no any impairment loss. Okay. There is no any impairment loss. Okay. So in this case, we have identified the impairment loss. In CGU A is 6 million and in CGU B there is no any impairment loss. Now the question is, how much of impairment loss has to be allocated to the assets other than the corporate asset and the corporate asset? Okay. So friends, in this case, the impairment loss on CGU has to be allocated as impairment loss on CGU, impairment loss on corporate asset. Okay. So total impairment loss is 6 million. The value of the asset other than corporate asset is 20 million. The total value including corporate asset is 24 million. Okay. Again, the total value of the impairment loss is 6 million. The value of the corporate asset is 4 million. And the value of total CGU is 24 million, which is including of corporate asset. So in this case, 5 million will be the impairment loss on other assets of the CGU, and 1 million will be the impairment loss on the corporate asset, which is into CGU A. Now what is the revised carrying value? Guys, what is the revised carrying value? The revised carrying value is CGU A is equal to how much amount? 20 minus 5 is equal to 15 million. What about CGU B? CGU B, how much was there? 30 million. And what about corporate asset? For corporate asset, it was 4 plus 6, 10 million was there, minus 1 impairment loss, 9 million. So the corporate asset value was 9 million. The value of CGU A was 15 million. I hope this question is clear to everyone. Please let me know if you have any doubt on this Ind AS 36. If you have any doubt so far, any doubt in allocation of corporate asset. Do you have any doubt? Shall I move ahead? Kaustav, Chavi, Nanda, Pujita, Ambika. Ambika, the revised carrying value is of course 24. If you will see, so 24 minus 5 is equal to 21. So Ambika, 24 minus 5 is not 21. See, first of all, what was the carrying value for the CGU A? The carrying value of the CGU A was 20 million. And the value of corporate asset allocated to CGU A was 4 million. Okay. Now the thing is, this corporate asset is a particular asset, and you cannot calculate the individual impairment loss on this corporate asset because this corporate asset is not a cash generating asset. Okay. So that is why, first of all, you have allocate the value of corporate asset into the CGUs, into the CGU. Okay. Then what you have done? Then you have arrived at a carrying value including of corporate asset, which is 24 million in this case. Okay. Then the recoverable amount was 18 million. So total impairment loss was 6 million. Now if the total impairment loss was 6 million, we need to calculate out of this 6 million, what is the portion which should be allocated to corporate asset and what is the portion which should be allocated to the other asset of the CGU. So in this case, it has been allocated in the ratio of 20:4. Okay. So the revised carrying value of the corporate asset in CGU A is 3 million and the revised carrying value of other asset is 15 million. This 15 plus 3 becomes 18 million. Okay. So Ambika, yes, you can do 24 minus 6 is equal to 18. So what I have done? So that is why the total impairment loss we have calculated is 6 million. But this corporate asset has to be shown in the balance sheet separately. This building has been shown in the balance sheet separately. So there is an impairment on this particular portion. There is not any impairment on this particular portion. If you will see in CGU B, there was no any impairment. Okay. So this building, the total value of the building is 10 million. This 6 million pertain to CGU B, on which there is no any impairment. But on CGU A, 4 million, there is an impairment. And this building has to be shown in the balance sheet separately. At what value you will show this building separately? At what value? So of course you need a value. So that is why the value will be 10 minus 1, 9 million. Okay. And the value of other assets is 20 minus 5, 15 million. Is it okay, Ambika? So this CGU concept is only for the disclosure, only for the impairment assessment. But in the balance sheet, you will show the assets separately. Is it right? Can I move ahead? Okay, so Pujita has confirmed. Sir, everything is clear. Great, Pujita. Guys, now I'm going to discuss a very important concept. Allocation of impairment loss on CGU. So we have discussed the meaning of CGU. We have discussed what is CGU, how this CGU has been identified. Okay. So what about if the CGU is having a goodwill? What about if the CGU will not be having any goodwill? So frequency, timing, we have discussed so many stuff. We have discussed the concept of corporate asset, allocation of corporate asset, and calculation of impairment loss on corporate asset. Okay. Ambika, have you clear on this aspect? Now we are discussing a very important concept of allocation of impairment loss on CGU. Allocation of impairment loss on CGU. Okay. So let me explain this concept with the help of an example. For example, there is a CGU A. Okay. This CGU A has three assets: goodwill, then your building, then your machinery, then your patent. Okay. So this CGU has four assets: 1, 2, 3, 4. Now the value is, the carrying value of these are: goodwill is, let's say, 20 million, building is 10 million, machinery is again 10 million, patent is 30 million. Okay. So what is the total carrying value? 30, 50, 70 million. Now the company is assessing the impairment on this particular CGU A, and the revised carrying value, the revised carrying value is, the recoverable value is, for example, the recoverable value is, so this is RV, recoverable value, and it is 40 million. The recoverable value is 40 million. Okay. So this is recoverable value. In this question, recoverable value of CGU A, recoverable value of CGU A is equal to 40 million. Okay. Now the thing is, what is the impairment loss here? What is the impairment loss? If the recoverable value is 40 million, then what is the impairment loss? Of course, it is a 30 million. It is 30 million. Am I right? Now the question arises, sir, in CGU A, there are four assets: goodwill, building, machinery, patent. The total carrying value is 70 million and the recoverable value is 40 million. Okay. Now the impairment loss on this entire group of assets is 30 million. Now how to calculate, how to allocate? Because in the balance sheet, this goodwill will be shown separately on the face of the balance sheet. This building will be shown separately. I mean to say, this building and machinery will be shown as a property, plant and equipment, and this patent will be shown as an intangible asset. These three items will be shown separately in the face of the balance sheet. Sir, how to calculate the revised carrying value? How to calculate the revised carrying value? How to allocate the impairment loss of 30 rupees into these 4 assets. Kaustav, do you have any view on this? Pujita, Nanda, Rohan, Niharika, what is your view on this? How to do this allocation? We are discussing how to allocate an impairment loss on cash generating unit. So how to do this? Please try to find out the solution. So what is your view on this? Guys, what is your view? So Ambika is saying, sir, please allocate based on the carrying value. Okay. So let me tell you, the standard says that, Ind AS 36 says that, guys, if there is an impairment loss on the group of the asset, okay, in that case, what is goodwill? What is goodwill? Technically, goodwill is a fictitious asset. Am I right? So you are saying that, of course, I have a value in the market. Okay, you are saying this goodwill is not a separable asset. Okay, since it is a purchase goodwill, so it is allowed to be recognized. But I am saying that my cash generating unit has a goodwill which is of 20 million. Okay, and now I am saying the value of my entire group of asset has been decreasing, has been falling down. It means my efficiency, my future economic benefit, my ability to get the future economic benefit from this group of assets is getting down. So first of all, standard says that if there is a loss on the CGU and if goodwill is there, first of all, you have to allocate the entire loss to goodwill. First of all, you have to allocate the entire loss to goodwill. Yes, Kaustav, you're right. Kaustav is saying, sir, first goodwill will be eliminated. Yes, in this case, out of this 30 million, entire 20 million has to be gone to goodwill. Okay, and in this case, the revised carrying value of the goodwill will be zero. Now I go to Ambika. So Ambika has told me, sir, it has to be allocated pro rata on the basis of carrying values. Now Ambika, I have used the point mentioned by Kaustav. Now I am using your answer. So yes, the remaining 10 million I need to allocate in the ratio of the carrying value of the remaining asset, which is 1:1:3. So in this case, for building, I have to charge an impairment loss for 10 multiplied by 1 divided by 5, which is 10 by 50, let's say 10 by 50. Again for machinery, I'll do 10 multiplied by 10 by 50. For patent, I will do 10 multiplied by 30 by 50. So what is the answer? It is 2 million. It is 2 million, of course. It is 2 million. It is 2 million and it is 6 million. Okay. So what is the revised carrying value? 8 million. 8 million and 30 minus 6, 24 million. So what is the total? The total is 40. The total is 40. Is it clear? Is it clear or not? Ambika, Pujita, Kaustav, Rohan, Nanda, is it clear? So guys, how to allocate an impairment loss on CGU? First of all, you have to hit the goodwill. Then you have to allocate the remaining impairment loss pro rata on the carrying values of the remaining asset. But there is an exception. Sir, what happens if for example, in this case, whatever you have taken in this case, for example, the value of the machinery is known. Okay. The company can calculate the value of the machinery independently. Okay. So I'm not saying, for example, this machinery can generate the cash flow independently, but these 3 assets cannot generate the cash flow independently, and hence these 3 assets are clubbed with the machinery. machinery. Okay, so that the entire will become a CGU. Okay, so the company can calculate the value of the machinery independently, and the value of the machinery, the recoverable value of the machinery is 12 million. The recoverable value of the machinery is 12 million. So now two informations are given in the question. Two information. What are the two information? The first one is recoverable value of CGU A is 40 million and recoverable value of machinery is 12 million. So I have revised my question and I have told you that the recoverable value of CGU A is 40 million, but one information is also given that the company can identify the recoverable value of machinery and it is 12 million. And it is 12 million. Now, what will be the revised carrying value? What will be the revised impairment loss? Tell me how to allocate the impairment loss. How to allocate the impairment loss? So friends, in this case, the recoverable value of the entire CGU is 40, it will become 40. The entire impairment loss is 30, it will always be 30. Okay. Now let's see. First of all, out of 30, we need to charge goodwill. So the carrying value, revised carrying value of the goodwill is 0. Now, out of these three assets, now the remaining loss is 10 million. Out of these three assets, this particular one asset is having a recoverable amount more than the carrying value. So in this case, there will not be any impairment charge on machinery. There will not be any impairment charge on machinery. And the revised carrying value of the machinery will always be 10 million. Now the remaining 10 million has to be charged on building and on patent pro rata in the proportion of their carrying value. So what is the revised value of the building? Minus 10 multiplied by 10 by 40. So 10 plus 30 is 40. For patent, it is minus 10 multiplied by 30 by 40. So this is coming out at 4 and 10. So it is 2.5. Roughly it is 2.5 and it is 7.5. So the revised value is 7.5 for the building and 22.5 for the patent, and the total will be 40. Okay. I hope it is clear to you guys. I hope. Guys, I hope it is clear to you guys. Students, is it clear? So what we have learned how to allocate the impairment loss, how to allocate the impairment loss on the CGU. While allocating the impairment loss on CGU, you need to hit the goodwill first, then the remaining impairment loss pro rata on the carrying values of the remaining assets, provided if a particular asset has a carrying value or a particular asset has a recoverable value which is more than the carrying value. In that case, that particular asset will not be charged for impairment, and the remaining assets has to be charged for impairment pro rata on the basis of their carrying values. Okay, so these are the three scenarios. Okay, yes. So now we are moving on to a case study which is given in the institute study material. Okay, so just a minute. So we discussed this impairment loss allocation part. Yes. Illustration number 24. Illustration number 24. Page number, although it is also right on your screen. Page number 7.253. XYZ Limited has a cash generating unit plant A as on 1st April 2001, having a carrying value of rupees 1000 crores. So it is a cash generating unit and the carrying value on 1st April 2001 is 1000 crores. Plant A was acquired under a business combination and goodwill of 200 crore was allocated to it. Okay. So there was a goodwill of 200 crore also. It is depreciated on a straight line basis. So this CGU has two assets. One is 1000 crore worth of plant and 200 crores worth of goodwill. So 1200 crore is the total value of CGU. And the depreciation has been charged on a straight line basis. Plant A has a useful life of 10 years with no residual value. So the life of the plant is given 10 years. Method of depreciation is SLM. So it means every year 1000 divided by 10, 100 crore depreciation needs to be charged every year. Okay. On 31st March 2002, it means after a year, plant A has a recoverable value of 600 crores. Calculate the impairment loss on plant A. Also prescribe its allocation as per Ind AS 36. So basically this plant A is a cash generating unit which is having two values. One is goodwill, one is other than goodwill. Okay. And the recoverable value after 1 year is also given. So we need to calculate the impairment loss on plant, and also we need to prescribe the allocation as per Ind AS 36. Okay. So let's solve this case study. Illustration number 24, page number 7.253 of ICAI study material. So friends, in this case, what is the cost of the CGU? In this case, this is your CGU, plant is the CGU, and it has two values. One is plant, one is goodwill. 1000 crores is the value of the plant, 200 crores is the value of the goodwill, 1200 is the total. Now, it is a value on 1st April 2001. 1st April 2001. Now, carrying value as at 31st March 2002. What is the carrying value? So, depreciation needs to be charged. So, in this case, depreciation needs to be charged. So, what is the depreciation? Depreciation is 100 crores. So, the revised carrying value of the plant is 900. The carrying value of the goodwill is 200. The total value is 1100 crores. Okay. Now the recoverable value of the plant is given. So what is the recoverable value? So here recoverable value is given. Recoverable value. It is given at 600 crores. And we need to charge the impairment loss. So how to charge the impairment loss here? First of all, what is the total impairment loss? The total impairment loss is 1100 minus 600, which is 500. So total loss is 500. So in this 500, first of all, you need to hit the goodwill. You need to strike off the goodwill. The revised carrying value of the goodwill, recoverable value of the goodwill will become 0. And the remaining impairment loss you need to charge to plant, minus 300. So the value will become 600. So this is the allocation as per Ind AS 36. Is it clear? Friends, is it clear to you guys? Is it clear? Ambika, Pujita, Kaustav, Rohan, Nanda. I hope it is clear to everyone. So Ambika is saying first 200 to goodwill, then 300 to plant. Yes, you are right. Okay. So friends, now we will have a break for 5 minutes. So it's 8:51 now. We'll start at 8:56. So we'll have a break for 5 minutes only. After that, we will do the next two remaining concepts. So we have already understood the concept of allocation of impairment loss with the help of an example which I have given you for this goodwill, building, machinery and patent. So I have taken two situations, one where we have allocated the impairment loss first to goodwill, then pro rata on the carrying values of the other asset. Then I have also taken a situation where one of the assets carrying value can be calculated, I mean to say recoverable value can be calculated, and the recoverable value of a particular asset is more than the carrying value. In that case, the impairment loss is not required to charge on that particular asset, but on the remaining asset, it has to be charged pro rata. Okay. Then we have done a case study, which is from Institute Study Material, illustration number 24. So for the benefit of you guys, for the benefit from the examination perspective, I would request each one of you to solve all the case studies, solve all the illustration which is there in the Institute Study Material. So Institute Study Material has every kind of illustration. You are requested to solve every illustration from the Institute Study Material. So that is more than enough. Okay. Now, so any query so far? I hope all the concepts have been cleared so far. So all the concept, whatever I taught you, everything is clear so far. Any doubt related to the topics which I have taught you till now? Any doubt? Okay, great students. So 4 students have confirmed that they have understood everything. Great. Okay, so let's move on. Now the thing is, we understood what is recoverable value. We understood how to calculate impairment loss. We understood that when to calculate an impairment loss, I mean to say when to calculate a recoverable amount. So we understood when there are indicators, we need to do the impairment assessment. Whenever there is an indicator. Okay. So then we discussed how to calculate fair value less cost to sale, how to calculate value in use. Then we discussed that how to calculate value in use, what is cash flow, what is discount rate. Then we discussed if impairment assessment on an individual asset is not possible, then we need to look for the group of the asset. Group of the asset means we need to look for the cash generating unit. Then we understood the concept of cash generating unit. Then we understood the concept of goodwill. So goodwill needs to be allocated to the cash generating unit. We need to understood the concept of corporate asset. Corporate asset value needs to be allocated to the cash generating unit. Okay. Then we understood how to allocate the impairment loss on the cash generating unit. We discussed first to goodwill, then pro rata on the remaining assets. Okay. Now the thing is, sir, for example, the company has opted for a cost model. Okay, for a building, or let's say for a property, plant and equipment, the company is using cost model. Pujita, what is meant by cost model? Cost model means the company has recognized the asset at cost and the company is continued with the cost. Okay, so whatever accumulated depreciation is there, it has to be deducted, and if there is any impairment, that has to be deducted. Okay, so the company is opting for a cost model. Let's say there is a building. On 31st March 2002, the value of the building is, let's say, 50 lakhs. On 31st March 2005, there was a negative announcement. So government has announced that we will pass a highway on this building and this building will become close to highway. So of course there is a lot of noise, there is a lot of pollution. So the value of the building has gone down. Okay, and there will be a probability of accident as well. So the value of the building has gone down. So there is an impairment indicator on this date. There was an impairment indicator and it has gone down by, let's say, 10 lakh and it becomes 40 lakh. Okay. Now on 31st March 2010, the government has announced that we will not build highway near to this building. We will build a green park. We will build a green park near this house. We will build a green park near this building, and hence the value of the building has suddenly increased and the value of building become, let's say, 80 lakhs. the value of building become 80 lakhs. Now my question is, can reversal of impairment is allowed? Whether reversal of impairment loss is allowed? How much impairment loss has been recorded till now? 10 lakh rupees of impairment loss has been recorded so far. 10 lakh. So now this 40 will become 80 lakh. So first question, whether reversal of impairment is allowed. Second question, if yes, to what extent? Second question, if yes, to what extent? What is your answer? What is your answer? Whether reversal of impairment loss is allowed, answer is yes. To what extent, we'll discuss later on, but yes. If indicators are present, which indicator? You remember, we have discussed two indicators, internal indicator and external indicator. So in internal indicator, we discussed the asset is providing a lower performance than what is expected. For example, the expectation was that this asset, this vehicle, this car will provide a mileage of 20 km per liter. Okay, but this car is providing a mileage of, let's say, 14 or 13 km per liter. So it is providing a efficiency, or it is providing a performance which is less than the expected performance. So in this case, it is a internal indicator of impairment. But for example, suddenly the efficiency or performance of the car has been increased. Okay, so now the car is providing a mileage of, let's say, 22 km per liter. The company has done a servicing of the car, the normal servicing, and after normal servicing, the value of the car or the mileage of the car has been increased suddenly. Okay, so it means, so when we were discussing earlier, the performance of the asset is lower than the expected, so it is an indicator of impairment. Now the performance of the asset become better than the expected. Now it is a reverse indicator of impairment. So whenever there is a reverse indicator of impairment, the company has to check the recoverable amount. The company has to identify the recoverable amount for the purpose of reversal of impairment loss. And hence, yes, impairment loss can be reversed if there is a negative indicator of impairment or a reverse indicator of impairment. Okay. Second, what could be the example of external indicator? For example, if you remember, we have discussed the increase in the market interest rate. So market interest rate are increasing. So whenever market interest rate will increase, your value in use will go down, because this interest rate, discount rate is associated with the interest rate, and whenever interest rate will go up, your value will go down. Okay. So friends, if the interest rate will go down, in this case, the value in use will go up. So decrease in interest rate is a reversal, is an indicator impairment, is a reversal indicator of impairment, reverse indicator of impairment, which is external impairment, external indicator. Okay. So again, when there is an external indicator which says that impairment loss needs to be reversed, so it should be reversed. So this is an internal and external indicator of impairment, which is a reversal of impairment. Okay. So let me share my presentation. Is it visible? Is this presentation visible? So impairment loss recognized in prior periods should be reversed if there is an indication that such losses does not exist any longer. External indicator, market value has increased significantly. Significant favorable changes in technological, market, economic or legal environment. Interest rate has been decreased. Okay. What could be the internal indicator? Significant favorable effect in the use of the assets. Economic performance of the asset is better than the expected. Okay. For example, the company has 5 machines which is used for production of blanket, which is used for manufacturing of blanket. Okay. Now, since the temperature was stable since last 2-3 years, and the company was only using a single machinery, for the production of blankets, and the 4 machinery was kept in godown, and hence it was lying idle. It was not providing any productivity. So the company was assessing an impairment loss for that particular machineries, Okay. Now, in the current year, so that the weather become extreme and it become extreme cold, and the demand has built up, and the company needs to take all those 4 machines from godown to the production place, and now the company is using this entire 5 machinery for production because there is a huge demand for those blankets. Okay, so in this case, this is again an internal indicator, or this is an indicator that the demand has been significantly increased and the use or performance of the asset has been significantly increased. So in this case, there is a need for assessing the reversal of impairment loss again, and there is a need for calculation of the recoverable value. Okay, is it okay? Have you understood? So we need to see if there is an external or internal indicator of reversal of impairment. In that case, the impairment should be reversed. Okay. So reversal of an impairment loss shall not exceed the carrying amount that would have been determined had no impairment loss been recognized for the asset in the prior years. Reversal of an impairment loss for an asset other than goodwill shall be recognized immediately in profit or loss. Any reversal of an impairment loss of a revalued asset shall be treated as a revaluation increase in accordance with that Ind AS. Further depreciation will be charged on the revised carrying amount. What does it mean? It says that, first of all, it says that you need to see if the company has opted for the cost model, then reversal of impairment loss, then the reversal of impairment loss will be to the extent of carrying amount, had the impairment never been happened. What does it mean? For example, on 1st April 2011, the cost of the asset was 100. The life was 10 years. So what is on 31st March 2012? What will be the carrying value? The carrying value So now, on 31st March 2014, the recoverable value will become 75. Okay. The recoverable value becomes 75. So standard says that had this impairment never been occurred, if the company has not charged impairment loss at any point of time, what should be the carrying value at the end of 31st March 2014? So the carrying value at the end of 31st March 2014 will be how much? So there will be 3-year depreciation. 11, 12, 12, 13, 13, 14. So carrying value had the impairment never been occurred is 100 minus 30 is equal to 70. Okay. So carrying value as on 31st March 2014 had the depreciation never been occurred will be 70. What is the carrying value as of now? So on 31st March 12, the recoverable value is 70. So this 70 has to be depreciated over a period of 9 years. Okay. Then what is the carrying value? What is the actual carrying value? What is the existing carrying value? The existing carrying value is equal to 70 minus 70 by 9 multiply by 2. Because this will use for the revised depreciation. 9 years is still to be gone. So 70 is the revised carrying value. So what is the per year depreciation? 70 by 9 multiply by 2. 70 divided by 9 multiply by 2. So it is 15. It is 15. So 70 minus 15 is equal to 55. Now, my dear friends, the recoverable value is 75. In the question, it is given that on 31st March 14, the recoverable value is 75. The existing carrying value is 55. So do I need to reverse the impairment loss to the extent of 20? Tell me, do I need to reverse the impairment loss to the extent of 20? Or do I need to reverse the impairment loss to the extent of 70? In this case, standard says that you are not required to reverse the impairment loss greater than what could be the carrying value had you never charged any impairment loss. So this should be 70. This should be 70. So in this case, how much impairment loss needs to be reversed? It should be reversed to the extent of 15 rupees. To the extent of 15 rupees. Okay. So my dear friends, impairment loss, I am giving you a simple formula. Impairment loss which is required to be reversed in this case, impairment loss which is required to be reversed, impairment loss to be reversed is equal to lower of, what is lower of? Carrying value. Impairment loss to the extent reverse is equal to lower of carrying value if the impairment never been happened. Impairment never been occurred or happened. Never been occurred. So Pujita, you are right. Pujita is saying it means only depreciation needs to be deducted to arrive at a carrying value if the impairment never been occurred. You're right, Pujita. Second one is recoverable amount. So in my example, recoverable amount was 75 and the revised carrying value was 70 if the impairment never been occurred. So what is lower? Ambika, what is lower, 70 or 75? So 70 is lower. 70 is lower, and hence we have reversed the impairment loss to the extent of 70, which is 15. 70 minus 55. Okay, perfect. Costa. Again, I'm explaining. So first of all, we were discussing whether the impairment loss can be reversed. Yes, it can be reversed. Okay. Now, to what extent it can be reversed? If the company has opted for cost model. So what is the cost model? In cost model, you are not doing any revaluation, but you are charging an impairment loss. You are calculating a recoverable amount. Okay. So if the company has opted for cost model, then the impairment loss will be reversed in P&L. Okay, because there is no OCI in case of a cost model. So if there is a reversal of impairment loss, then to what extent impairment loss can be reversed? So impairment loss can be reversed to the extent of lower of. Lower of what? First of all, you have to calculate the carrying value. So what is my carrying value as on date if the impairment has never been occurred? Like in my example, we have calculated the carrying value, which was 100 minus 30, which comes to 70. Is it okay, Costa? Is it okay? So first of all, it was 100 minus 30, which is 70. What is the second one? The second one is you need to calculate recoverable value on that particular date. What was the recoverable value? It was 75. In my example, it was 75. So what is the lower, 70 or 75? 70 is the lower. And what was the actual carrying value? You remember, in the first year end, we have charged an impairment loss and the carrying value was 70 at that point of time. So this 70 needs to be depreciated in the next 2 years. So the existing carrying value on 31st March 14 was 55. So we need to increase 55 to the extent of 70, not 75. Okay. So 15 rupees impairment loss is required to be reversed in the P&L. Okay. Okay, perfect, Vastav. Now the second point, sir, what happens if the company has opted for revaluation model? What happens if the company has opted for revaluation model and there is a reversal of impairment? In case of revaluation model, it will be treated as revaluation increase or decrease. It will be treated as revaluation increase. Okay, it will be treated as a revaluation increase. So whatever amount which have been debited in P&L, that has to be reversed in P&L, and over and above will go to OCI. So in case of a revaluation model, it can go beyond. It can go beyond the revised carrying value. It can go up to recoverable value. Okay. So there is no concept of lower in case of revaluation model, because we understood revaluation means fair value, and fair value could be more than the carrying value or more than the cost also. Okay. Great. So in case of a revaluation model, it has to be treated as a revaluation increase, and it will go to OCI to the extent of over and above amount which have been charged to P&L. Third, whether reversal of goodwill is allowed. Whether reversal of goodwill, reversal of impairment on goodwill, reversal of impairment on goodwill, is it allowed? Whether reversal of impairment on goodwill, is it allowed? Friends, is it allowed or not allowed? Reversal of impairment on goodwill is not allowed. It is not allowed. Okay. So reversal of impairment on goodwill is like a creation of self-generated goodwill, and hence it is not allowed. It is prohibited by Ind AS 38, read with Ind AS 36. Okay. Any doubts so far? Any problem? Yes, Ambika, you're right. Reversal on goodwill is not allowed. Okay. So let me share my screen. Then I'll discuss one of the comprehensive case study on reversal of impairment. Okay. So that you will be able to clear this concept pretty well. Let me share my presentation. We discussed this internal indicator and external indicator part. So impairment loss recognized for goodwill should not be reversed in a subsequent period. We discussed this. Reversal of an impairment loss for a CGU should be allocated to the asset of the unit, except for goodwill pro rata with the carrying amount of those assets. Please remember, even though in case of CGU, what we have done, first we have eliminated the goodwill, then we have charged impairment loss pro rata on the basis of carrying value of the asset. Same way, reversal of goodwill in CGU is not allowed, but on the remaining assets, this impairment loss is required to be reversed pro rata on the basis of their carrying values. Okay. Such increase in carrying amounts will be treated as a reversal of impairment loss for individual asset. And for individual asset, such increase in carrying amount will be treated as a reversal of impairment loss. Okay. And what is the treatment? If the company has opted for cost model, then you cannot go beyond the lower of carrying value had the impairment loss never been occurred, and recoverable value on the debt. If the company has opted for revaluation model, then it can go beyond that also. Okay. So now we'll discuss this case study, reversal of impairment loss. So this is a comprehensive case study, and this will give you a proper insight on how to reverse an impairment loss. Okay. So this is illustration number 13 of Institute study material. Page number 7.239. Page number 7.239. First, we will read this case study. Then we will discuss this particular illustration. Okay. So reversing an impairment loss for goodwill is not permitted. Sorry, we discussed this. So reversal of impairment loss, illustration number 13. On 1st April 2001, Venus Limited acquired 100% of Saturn Limited for rupees 4 lakh. Okay. So this company, Venus Limited, has acquired 100% of Saturn for rupees 4 lakh. And the fair value of the net identifiable asset of Saturn Limited was rupees 3,20,000 and goodwill was 80,000. So the company has acquired an asset worth of rupees 3,20,000 and 80,000 will go to goodwill. Saturn Limited is into coal mining business. On 31st March 2003, the government has cancelled licenses given to it in few states. Okay. So the company is into coal mining business, and on 31st March 2003, that is after 2 years, the government has cancelled license given to it in few states, and hence it is an external indicator of impairment. Okay. As a result, Saturn Limited revenue is estimated to get reduced by 30%. Okay. So the company is estimating that my revenue will be decreased by 30%. The adverse change in marketplace and regulatory environment is an indicator of impairment. As a result, Venus Limited has to estimate the recoverable amount of goodwill and net assets of Saturn Limited as on 31st March 2003. Okay. So Venus Limited has to estimate the recoverable amount of goodwill first and net assets of Saturn Limited on 31st March 2003. Okay. So these two informations are also given. Then Venus Limited uses straight line method of depreciation. The useful life of Saturn Limited asset is estimated to be 20 years with no residual value. So the method of depreciation is given, which is straight line. Useful life is estimated to be 20 years. No independent cash inflows can be identified to any individual asset. So the entire operation of Saturn Limited is to be treated as cash generating unit. Due to the regulatory entangle, it is not possible to determine the selling price of Saturn Limited as a CGU. Its value in use is estimated by the management as 2,12,000. Okay. Suppose by 31st March 2005, the government reinstated the license of Saturn Limited. So after 2 years, the government reinstated the license of Saturn Limited, and now the management is expecting a favorable change in net cash flows. This is an indicator that an impairment loss may have reversed. The recoverable amount of the Saturn Limited net assets is re-estimated. The value in use is expected to be 3,04,000 and fair value less cost to disposal is expected to be 2,90,000. So in this question, three informations are given. First, which is on 1st April 2001. On 1st April 2001, there are two assets. One is 3,20,000 of assets and goodwill of 80,000. Okay. And on 31st March 2003, there is an indicator of impairment. And on that date, the value in use for the CGU has been given at 2,12,000. Okay. Then after 2 years, on 31st March 2005, there is a favorable indicator of impairment, and the recoverable value on that particular date is also given. So recoverable value in value in use is given and fair value less cost to sell is given. So 3,04,000 and 2,90,000. So what is recoverable value? It is higher of fair value less cost to sell and value in use. Okay. So now we need to calculate. The reversal of impairment and impairment. Okay. So let's solve this particular example, particular illustration. I would request all the students that please raise if you have any doubt in this particular standard. This is a very critical, very important standard. I would request each one of you, doesn't matter if it is related to last class or if it is related to today's class, so it doesn't matter. If you have not understood any particular concept, then please raise a question. Okay. So what is the cost on 1st April 2001? First of all, on 1st April 2001, what is given? Your goodwill is equal to 80,000. Your asset other than goodwill is 3,20,000. The total is 4 lakh. The total is 4 lakh. Okay. Then the life of the asset is given. What is in other information? Useful life is equal to 20 years and SLM method is used. Straight line method is used. So on 31st March 2003, after 2 years, 31st March 2003. 31st March 2003. So what is the carrying value of goodwill? Of course, the carrying value of the goodwill is same. It is 80,000. What is the carrying value of asset? So carrying value is equal to 3,20,000 minus 3,20,000 divide by 20 multiply by 2, which is 3,20,000 minus 32,000. 3,20,000 minus 32,000. Am I right? 3,20,000 minus 32,000. So what is the value? 320 minus 32 is equal to 2,88,000. Is equal to 2,88,000. So on 31st March 2003, the carrying value is 2,88,000. So what is the total value? 288 plus 80 is 368,000. 3,68,000. This is the carrying value as on 31st March 2003. Now, what is the recoverable value? This was the carrying value. Now, what is the recoverable value on 31st March 2003? What is the recoverable value? Ambika, what is the recoverable value on 31st March 2003? Costa, what is the recoverable value which is given in this question? On 31st March 2003, it is 2,12,000. It is 2,12,000. So now what is the impairment loss? If it is 2,12,000, then what is the impairment loss? So impairment loss is equal to 368 minus 2,12,000, which is 8 minus 2, 6, 6 minus 1, 5. Okay. So it is 1,56,000. It is 1,56,000. 1,56,000. So this 1,56,000 has to be charged to both the assets. So how much we need to charge to goodwill? So goodwill has to be charged entirely. So goodwill has to be deducted entirely. Okay. So goodwill needs to be eliminated. Now how much balance will be left? So 1,56,000 minus 80. 1,56,000 minus 80,000. So 76,000. The balance impairment loss has to be deducted from 288. So 76 minus 288. This is coming out at 2,12,000. So this is 2,12,000. So only asset which is other than goodwill is left worth of 2,12,000. So this is your recoverable value on 31st March 2003. Now what has been happened on 31st March 2005? On 31st March 2005, the recoverable value on 31st March 2005 was how much? How much? What is the fair value less cost to sell on this date? What is the fair value less cost to sell? Fair value less cost to sell was 2,90,000 and value in use is 3,04,000. So what is the higher here? What is the higher here? What is higher? 3,04,000. So what is the recoverable value? So higher is 3,04,000. So recoverable value is 3,04,000. Should I increase? So this was the revised carrying value on 31st March 2003, which is 2,12,000, and recoverable value is 3,04,000. So should I increase? Should I increase this 2,12,000 to 3,04,000? Answer is no. I have to see what will be the carrying value what will be the carrying value had the asset never been impaired? What should be the carrying value had the asset never been impaired? Okay, so what should be the carrying value had the asset never been impaired? What could be the carrying value? So in this case, we will not reverse the impairment loss on goodwill. We will not see the impairment loss reversal on goodwill. We have to see only for the asset. So what was the value of the asset? The value of the asset was 3,20,000. You remember 3,20,000. So in this case, the cost of the asset, the cost was 3,20,000 minus depreciation for 4 years, which is up to 31st March 2005. So 3,20,000 minus 3,20,000 divided by 20 multiply by 4. So what could be the answer? So this will be 3,20,000 divided by 20 multiply by 4 is equal to 64,000. So 3,20,000 minus 64,000 is equal to 320 minus 64,000 is equal to 2,56,000. 2,56,000. Okay. So in this case, what is the carrying value? What is the carrying value on 31st March 5 if impairment loss has never been done? So what is the carrying value? The carrying value is 2,56,000. So what is lower? 3,04,000 or 2,56,000? So in this case, if you will see, what is lower? Pujita, what is lower? 2,56,000 is lower. Okay. So in this case, we need to consider. So revised carrying value will be 2,56,000. 2,56,000. So the value of the asset will be 2,56,000. So how much impairment loss is required to be reversed? How much impairment loss? 256 minus 212. So 2,56,000 minus 2,12,000 is required to be reversed. So how much? It is 44,000. So 44,000 of impairment loss is required to be reversed. Okay. Have you understood this part? How much impairment loss is required to be reversed? Sorry. So basically it is 2,56,000. I have missed one thing. So this recoverable value was on 31st March 2003. So I have missed one part here. So what is the reversal of impairment? First of all, the carrying value on 31st March 2003 was 2,12,000. Okay. And the total life was 20 years. So what is the remaining life? Remaining life is 18 years. So remaining life is 18 years. So now we need to calculate the carrying value on 31st March 2005. Okay, which is 2,12,000 minus 2,12,000 divided by 18 multiply by 2. So what is the number? 2,12,000 divided by 18 multiply by 2 is equal to 23,555. So let's assume 23,500. So 2,12,000 minus 23,500, which is 2,12,000 minus 23,500 is equal to 188,500. Now, what could be the revised carrying value? The revised carrying value is 2,56,000. To what extent? Impairment loss can be reversed? It can be reversed to the extent of 2,56,000. So impairment loss reversal is equal to 2,56,000 minus 1,88,500. This is 2,56,000 minus 1,88,500. 67,500. This 67,500 will go to P&L. this 67,500 will go to P&L. Yes, Pujita, you're right. Depreciation should be charged. Okay. So that part, that particular part I have missed. Okay. So the carrying value, the existing carrying value is 188,500, and it can be increased to the extent of lower of what could be the carrying value had the asset never been impaired, which is 256, and recoverable value, which is 3,04,000. So what is lower? Lower is 256, and that is why I have increased 188,500 to the extent of 2,56,000. Yes, Pujita, you're right. So Kaustav, is it clear? Ambika, is it clear? Whether this case study is clear to you guys? Again, I'll show this case study in my presentation because this is a very important case study. So this is the solution, other assets. Okay. Then you need to calculate the carrying amount of identifiable asset had no impairment loss been recognized. So historical cost is 320. Accumulated depreciation for 4 years 64. So carrying amount is 256. Now, what is the existing carrying value? The existing carrying value is 2,12,000 on 31st March 3, and the 2-year depreciation is 24,000. So technically, in the institute study material, it has been rounded off near to the thousands. Rounded off near to the thousands for the ease of calculation. It is mentioned there. Otherwise, it should be 23,500. Okay. So carrying amount is 1,88,000. Now you need to compare this 256 with 188. Okay. So the impairment loss previously recognized can be reversed only to the extent of lower of re-estimated recoverable amount or carrying amount had the impairment loss never been recognized, which is 2,56,000. So impairment loss reversal will be 68,000. Okay, because institute has taken the calculation nearest to thousands. This amount is recognized as income in the P&L, and the carrying amount of other asset after reversal of impairment loss will be 2,56,000. And from 1st April 2005, for the next 16 years, the depreciation will be charged on the basis of 2,56,000. Okay. Any doubt so far, friends? Any doubt so far for this particular impairment of assets? We have covered all the aspect of impairment of assets so far. So if you don't have any doubt, then it's a time of lesson summary. It's a Maggie time. So can we start our Maggie time? So let me wait for a minute. Then I'll start my Maggie time. Should I start my Maggie time? Okay, students are saying, sir, please start the Maggie time. Okay, so what is Maggie time? So it is 2-minute revision for the entire standard. So we discussed the objective and scope of Ind AS 36 when we have started this particular standard. Then we discussed identifying an asset that may be impaired by way of external indicator and internal indicators. Okay, and we discussed 3 assets: intangible asset having indefinite useful life, intangible asset not yet available for use, and goodwill arising in business combination. These 3 assets should not be wait for the indicator impairment, and annual impairment is mandatory. Annual impairment exercise. I'm not saying you have to charge impairment loss every year. There could be a situation where the recoverable amount is more than the carrying value. But the thing is, whether impairment exercise is required, yes, impairment exercise is required. Okay. Then you need to measure a recoverable amount which is higher of fair value less cost to sale and value in use. We understood these 2 concepts in detail, that what is fair value less cost to sale, what is value in use. If you remember, we have done a case study. We have done a case study for Mars Limited in case of calculation of a value in use. Okay. So we understood what is value in use. Even we have done a case study for foreign currency cash flow as well. Then we discussed recognition and measurement of impairment loss. Of course, we need to recognize an impairment loss in P&L. If the company has opted for a revaluation model, we will go by the revaluation increase or revaluation decrease. Okay. Then if it is an individual asset, in individual asset, the impairment loss has to be recognized in P&L according to cost model or revaluation model. In case of a CGU, we discussed that first goodwill has to be first impairment loss has to be charged on goodwill. Then on other asset, it will be on the basis of pro rata on their carrying values. Then we discuss the concept of CGU. What is the concept of CGU? It is the smallest identifiable group of asset which can generate cash flow independently. Okay. Then we discuss allocation of impairment loss. While discussing allocation of impairment loss, we have also discussed the concept of corporate asset. We have also discussed the concept of goodwill, which has to be allocated to the CGU at the lowest level. Okay. Then we discuss the concept of corporate asset. The corporate asset has to be allocated to the CGU, and after that, the impairment assessment has to be done. So once impairment assessment has been done, if there is any impairment loss, the impairment loss is required to be charged on a corporate asset and the other asset of the CGU on a pro rata basis. Okay. So then we discuss reversal of impairment loss. Reversal of impairment loss is required to be done when there is a favorable indicator. When there is a favorable indicator, the reversal of impairment loss on goodwill is not allowed. And in case of cost model, the reversal of impairment loss is allowed to the extent of lower of carrying amount had the asset never been impaired, and the recoverable amount on the date of re-estimation, whichever is lower. Okay. Then of course we discuss identify the disclosure requirement of intangible assets. So basically this is a disclosure requirement, theoretical part. You need to have a just reading on the disclosure part, which is not much relevant from the examination perspective. So friends, thank you very much. So we have completed this entire Ind AS 36 impairment of assets with the help of around 10-11 case study and my own examples, just to make you guys understood the concepts. I hope you have understood the concept very well. If you have any doubt, then I'll wait for another 1 minute or 2 minutes. Otherwise, I'll complete the session. So please confirm if you have any doubt. So one student is asking, sir, even he is confirming, sir, if we have calculated the fair value less cost to sell and it is already more than the carrying value, do we need to calculate, do we need to re-estimate the discount rate and calculate the value use? Answer is not allowed. If the fair value less cost to sell is already higher than the carrying value, then calculation of value in use is not required. Okay. Any other query? Any other query? Any query? Then one student is asking, sir, if the fair value less cost to sell cannot be calculated because the active market does not exist, but we can calculate the value in use, is it suffice to calculate the recoverable amount based on the value in use? Yes, it is okay. It is allowed. If the fair value less cost to sell cannot be calculated and the value in use can be estimated, then recoverable value is equal to value in use. Okay. Any doubt? Anything else? So no any queries there other than these two queries. So now once again, I would like to thanks to all of you. So my dear students, just stay safe, stay happy, and I would request all of you that please solve the entire illustrations of the Institute study material. This is your homework. So thank you so much. I hope you enjoyed the session. Thank you.